Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'd like to talk about property plans. So for those that aren't familiar with what I'm talking about, there's a host of businesses in Australia, growing number of businesses, particularly over the last 5 years, that will prepare a property strategy plan for you. So if you're interested in building a property portfolio, they will sit down and map out, what that might look like for you. And typically what they're going to do is work out what your investment capacity is, which is really your borrowing capacity plus also your cash flow, of course, and then spread that capacity across one or more properties. And if it's more properties, what does that look like in terms of maybe building in some geographical diversification, buying different types of assets and those sorts of things. They tend to charge around about $4,000 to $5,000 for this bit of advice or this report, if you like. And prices can vary, of course. And so what I wanted to talk about in today's episode is, are these worthwhile? Is it worthwhile going out and paying $4,000 to $5,000 for a property plan? Now, let me first put my vested interest on the table. I don't like to talk in this podcast about my business, what we do, how we can help you, any sort of sales pitches whatsoever. If you're interested, I will leave you to find that information. And if you're interested, it's easy to find. And so also, I like to come to this podcast with an impartial view. I like to leave room for the possibility that my previous stance on something is now wrong or maybe has always been wrong. So be open to, possibility of changes, different approaches, all those sorts of things. And so I try not to let, what I do on a day-to-day basis and what I've been doing for the last 20 plus years within my business influence, the information that I'm sharing on this podcast. But of course, I've spoken about a number of times the benefit of taking a holistic approach, that many investment decisions are multifaceted and they have wide-reaching implications. And so it makes sense that if I'm going to have a really well-rounded answer and harness the most amount of value, then I really need some input from tax accountants, I need input from mortgage brokers, I need input from buyer's agents, I need input from financial advisors. And if I can put all those people around the table and they can discuss this one issue in context of a longer term plan, the chances are I'm going to maximize my value. And property investing is no different, right? Like if I'm thinking about buying a property, I'm going to think about cash flow, I'm going to think about borrowing, I'm going to think about tax, I'm going to think about debt management, I'm going to think about how it fits into my longer term plan. It's a really good example of how a financial decision can be multifaceted. So therefore, my business offers holistic advice that sort of rounds it all out, looks at all aspects. Property plans, as I'll get into, have quite a limited scope and therefore generally I think limited value or can offer limited value in many situations. And so of course I've got a vested interest to mount that case, of course. So I just want to put that on the table. But having said that, about 10 to 15 years ago, all the years sort of mold into each other. I'm terrible at remembering when things happened, but about 10 to 15 years ago, we actually offered the service of a property plan. So this is specifically for investors, we would not talk about then super or shares, let's just talk about property, how you're going to build wealth using property. And we did that for many years successfully. It was commercially successful, but I just don't think it really created the most amount of value because really what we were doing is responding to a client requirement. That is, I love property, I only want to use property, but I prefer to actually widen the conversation and say, well, what you actually probably prefer, or most people do, is a really comfortable retirement and to make as much money over the next number of years while you're working. So you've got the largest pool of assets. That's what I'd argue you want to do. So let me show you which combination of assets might help you do that. And that's kind of the approach that we've been taking certainly for the last 10 plus years. And it's not because it wasn't commercially successful to offer property plans, but it's just that's what I believe is going to harness the most amount of value. And I don't think you can really build a great business unless it delivers a great outcome. And that's what I'm going to get to in this episode, of course. But I just wanted to mention that up front because it's going to be easy to throw stones at this episode and go, wow, Stuart, of course you're going to say property plans are no good because you sell holistic plans. Anyway, let's leave it there. So what I'd like to do is talk about some of the downsides to property, some of the shortcomings with a property plan, then I'll talk about some of the advantages. But before I get into that, I mean, a property plan might be relevant to you if you have decided that's all you ever want to invest in is property. Because really what a property plan will do is, it will tend to do, well, it can only do this because of the limitation of advice. It will work out, as I said, what your full capacity is today and over the next period of time until you retire, and allocate that full capacity towards investing in property. So it's not going to consider other assets. It's not going to consider the implications like your ability to make additional super contributions, or, whether you should also build wealth in other asset classes like shares. It's not going to do that. It's just going to really focus on property. Now, that's fine if you have decided that property is the only asset you ever want to invest in. And so a property plan on that occasion might be correct. But I would argue most people would probably, if you really press them, would probably say, no, I understand that, investing in super and shares and property, a combination of all those assets would make sense. And that's kind of what they probably really prefer rather than, going all in on property. There's a great quote by Maslow, and I quote, "I suppose it's tempting, if the only tool you have is a hammer, to treat everything as a nail." And unfortunately, if all I can talk about is property, then of course that's all my recommendation's going to be. Whereas I think investment preferences often reflect gaps in knowledge rather than permanent beliefs. For example, some people go, look, I don't like the share market. I invested once, I lost money. I don't want to go anywhere near it. Or I don't like the share market. It's really volatile. And both those things could be true, right? Maybe they have had a bad experience and it is volatile. It can be volatile, twice as volatile than property is. But if I can sit down and demonstrate to them, as I've done in this podcast many times, that there are share investing methodologies that are evidence-based, that are rules-based, that reduce that risk and that are proven to generate decent returns, and you have that conversation, people start to feel a little bit more comfortable because you're filling that knowledge gap. So sometimes we look at it just on face value to say that's a risk appetite, that's an investment preference. But really, to me, more often than not, it's just someone exhibiting the fact that they've got a bit of a knowledge gap there. And if you can fill that knowledge gap, perhaps then they become more comfortable. Now, I'm not attached to it. Maybe there's people out there, and I'm sure there are, and there definitely are, that just won't go anywhere near the share market regardless of the amount of knowledge they have. That's fine. But it's really about discovering that because, of course, if I'm going to go to a financial advisor or if I'm going to build a financial plan more correctly, really I want to use the assets that give me the most amount of success and generate the most amount of wealth. Do I really care what combination of or type of assets that is? Probably not. It's really just the end goal that I'm most concerned about. And that's why I think, being asset class agnostic, not being too focused on property or too focused on shares, I think is a better approach. But just wanted to make the point that, of course, if you have decided that property is the only thing, then a property plan could be appropriate for your circumstances. Okay, so let me share some of the limitations of these plans and I'll talk about some of the advantages. So as I spoke about, in terms of decisions being multifaceted, certainly investing in property is one of them. If you think about it, you've got to think about borrowing arrangements, cash flow management, taxation. And I think taxation not only now, which people tend to think about, how should I own this property? How is it going to maximize my negative gearing benefits next year? And that's important to consider. But, how does that asset then behave longer term as well? So what I'm talking about there is if I have to sell the asset or the plan is to sell the asset, what about capital gains tax? What about land tax? These sorts of things. Then you want to think about asset protection and risk management. Risk management really around personal insurances, particularly like income protection. If you've got a gearing strategy and you're borrowing, then I think income protection is really just the cost of doing business. It's an investment cost, if you like, to protect your ability to be able to continue to make loan repayments if you have an accident or illness. And then asset protection is really, of course, around making sure that if you're going to build a good nest egg, that it's protected in case, you've got certain risks, whether it's being sued or a relationship breakdown, these sorts of things, at least that you can try and preserve some of that wealth. And then finally, retirement strategy. So that's things like, how are you going to repay the debt? To what extent are you going to repay the debt or offset the debt? How does super fit into your broader strategy? And whether you need to invest in other asset classes in addition to property. So really they're the 5: borrowing, cash flow, tax, asset protection, risk management, and retirement strategy are really the 5 subject matters that you really need to think about when investing in property if you're really going to make the smartest decision and harness the most amount of value. The problem with that is, firstly, tax advice can only be provided by a registered tax agent. And registered tax agents are authorised by the Tax Practitioners Board, or TPB. And you can go on the website, you can find a public register of people that are registered tax agents. I'm a registered tax agent, of course, my business is. And so you just got to be careful. I've seen lots of situations where buyers agents, mortgage brokers, particularly bankers. I've heard lots of stories about bankers, that is staff that work at a bank, giving advice to clients or suggesting a particular loan structure or a particular approach. And it's well-meaning. I'm not suggesting that they're, trying to do anything dodgy or anything like that, but the advice has been terrible. Just be really, really careful. Make sure if you receive any tax advice, even well-meaning advice to say, look, this is what we think you should consider, make sure you go and check it with a registered tax agent. The other thing, if they're going to talk about borrowing in a property plan, they might need an Australian credit license to do that. Now, if it's just general conversation around cash flow, around how much you can borrow, if it doesn't really relate to a credit contract, it's possible they don't need an Australian credit license, which is a bit crazy because if you're going to talk about and advise someone to, go and borrow $2 million, surely it would make sense, I think, for a government to make sure that advice is regulated and the people providing it have the requisite sort of education and oversight and so forth. Unfortunately, that's not the case at the moment, but you do want to make sure that, if you're going to get a plan, that it's implementable. And so you really need to know that, okay, if I'm going to buy 3 properties, will CBA give me the money to buy 3 properties, or whichever bank? And to be able to do that, you need a credit license. And lastly, in terms of financial advice, I can give property advice, and property isn't defined as a financial product under the Corporations Act. The only time I need an Australian Financial Services Licence, an AFSL, to provide financial advice if it relates to a financial product. So even cash flow management or cash flow analysis and financial modelling isn't a financial product either. So I don't need a license to give you that advice. That's a problem too, because it means that you could be getting advice from someone that really doesn't, again, have the knowledge and education to provide that advice and to provide a high quality product to ensure that they're not going to provide the sort of wrong advice. Now, if the advice starts to bleed over into things like shares, ETFs, managed funds, superannuation, bank accounts, life insurance, these sorts of things, that definitely is a financial product. And then, therefore, if someone's going to give you advice on that, they need an Australian Financial Services Licence. So I think the biggest gap here is a registered tax agent. If you're going to pay for a property plan, taxation is going to be a big element. It's not going to include that. So if you're going to pay for that advice, you've then got to, I think, make an allowance for you spending some money on some tax advice to make sure that the property strategy is appropriate. Potentially, you've got to then take that plan off to your mortgage broker and make sure they run the rule over it, make sure it's okay. Mortgage brokers tend to not charge a fee, so there's not going to attract any additional costs there. And if it's quite complex, in terms of cash flow management, financial modelling, all these sorts of things, you need to then make an assessment, to my mind, whether you're going to rely on that information. So that goes to the reputation of the business that's preparing the property plan, of course, and then the individual that's preparing that property plan. What qualifications do they have? Are they members of any particular professional body? What sort of oversight do they have? Just to make sure that, not any person really any person walking off the street could sell you that plan. And so there's not a lot of regulation around it. And I think consumers need to be aware of this fact. So what are you really paying for? You're paying for someone to work out your borrowing capacity, prepare a template financial model. I mean, all financial models are template, but or run off a template, prepare a financial model, map it out, and decide how to spread that budget over a number of different properties. That's essentially really what a property plan is going to do. And you just then have to work out in your own mind, is it worth paying $4,000 to $5,000 to find the answers to those questions? So my first concern is really around the scope of the advice and whether that scope is going to actually deliver value to you. The next concern is really around, are there any sort of geographical limitations? So back in February, my colleague Campbell Wallace recorded a episode about the key attributes that make an exceptional buyer's agent. In fact, it was episode 345, so you can always go back and check. It was a very popular episode, by the way, so go back and check that one out. One of the critical attributes that Campbell highlighted was local market knowledge. You know, the primary reason for engaging a buyer's agent is really to lean on their experience and expertise. And now we can acquire knowledge, of course. That's relatively easy. Experience takes time. So you want to deal with someone that has operated in that geographical location for more than 10 years. So they've seen more than one sort of property cycle, and they know that, you know, the northern side of Smith Street's okay, it's investment grade. The southern side of Smith Street, for some reason, just doesn't work. And they know to steer clear then of the southern side. But, you know, if you didn't have that local knowledge, you wouldn't be able to sort of pick that up. And also, you know, property, there's idiosyncrasies with property. So, you know, a weatherboard property might be fine in a particular suburb or even a particular street, but a weatherboard might not be the right investment. Might need a brick veneer property in a particular location. Again, you need to know, you know, these idiosyncrasies, and that's why, you know, property's more, well, sort of part art, part science, really. And if you're going to take the science approach, as in, here's a checklist, if I can tick all the items, it's a good asset, you know, you invite yourself to make a mistake. So coming back to property plans, it's really then important for you to ask yourself the question, does the individual or business that's preparing the property plan for you have any geographical limitations? I mean, it's unlikely that the person that's preparing the plan is going to have expertise in a variety of markets, and they might not be able to implement in a variety of markets. Similarly, they might have a core of clients with a certain budget, and because of that budget, they've been buying properties in particular regional locations, for instance, and that might be their kind of go-to, if you like, or, you know, that's where their experience is. And so you then need to think about, how is that going to shape their advice as well? I mean, similarly, if they're, you know, in Melbourne or Sydney and they're just buying in blue chip locations and your budget doesn't suit that, again, that's not going to be appropriate as well. So you really need to think about the business you're dealing with. You need to then think about what geographical limitations. But the key thing here is you still want that geographical experience. And that can be difficult, right? Because there's a lot of borderless buyers agents that are, you know, offering to put your property plan together, and they'll buy something in Perth and they'll buy something in regional New South Wales and they'll buy something in Brisbane, you know, 20 Ks out of the CBD or something like that. And that might all sound really good, but they might not actually be geographical experts in any of those locations. So you want both. You want a bit of a broad base if possible, but also you want geographical expertise, and that can be difficult to achieve, which is kind of the point I'm trying to make with these property plans. Okay, let's talk about some of the positives then. I mean, if you are of a mind to build a property portfolio, and at least at this stage of your life, or maybe for the rest of your life, you've decided that you're not really interested in any other assets, having acknowledged all the benefits, and you just think, no, I'm not going to do it, then I think sitting down and working out or mapping out a bit of a plan around what a property portfolio looks like is really worthwhile. And there's probably really two things you want to think about. Firstly, you want to think about geographical diversification, because owning property in different markets, and really what I'm really talking about is probably really different states, really does kind of smooth returns, reduces portfolio risk, because, you know, each sort of market is in a different point of the cycle. And so if you own 4 properties, for example, 2 might be in a flat cycle and 2 might be in a growth cycle, but at a portfolio level, you know, at least your net worth is moving ahead. and then you can implement your plans, which might be borrowing against equity and continuing to invest or something like that. But geographical diversification, I think, is really important. Also can help you minimize any future land tax liabilities as well. It can make a big difference on land tax. Maybe not initially, but certainly in the long run. Land tax is pretty insidious because the land value starts to really grow significantly after you've held it for, say, 20 years, for instance. But you don't want to be looking back in 20 years' time, kicking yourself because you should have spread your property assets across multiple states. The second thing you want to really think about is sort of property type, price points, and tenant profile. So, if you think I'll buy one in Queensland, one in New South Wales, and one in Victoria, then you want to think about what types of properties am I buying, whether they're houses or apartments or villa units or townhouses. Again, the price point, both in terms of rental amounts and actual dollars in terms of purchase price, and then the type of tenants you're going to attract to those properties as well. And you have to obviously then make those decisions in context of the market that you're buying in. That the villa units there's not that many in Brisbane, for instance. So if you're going to look for one, maybe it's not really the right thing to do. But, villa units are more common, I think, in Melbourne, for instance. So I think sitting back and really thinking about these things makes a lot of sense. But I'm not really sure you need to be really detailed about the planning. My personal journey, for instance, I've always had a mind to make sure I've got some geographical diversification. I tend to prefer houses over apartments, although I do own both. And it really then is driven to some extent by where in the growth cycle a particular market is at and what else I might be doing with my investment funds, whether I'm keener to sort of focus on the share market, for instance, at times versus property. So you want to have, it's a bit fluid. You want to have some flexibility to sort of accommodate those things, but you do want to think about, longer term, how you're going to build a portfolio, whether you need to go the extent of putting a really detailed plan together, that's a decision for yourself. I mean, one thing I would caution people about is it seems like a really popular idea, for instance, to build a property portfolio. Maybe it's driven more by ego than financial fundamentals, but the idea of let's go and buy 3 or 4 properties over the next 3 or 4 years and you've got this great property portfolio. That idea seems attractive to a lot of people, but let's not forget it's quality over quantity. I would much prefer to own, for example, one property that's worth $1.5 million than say 4 $500,000 properties. So that's $2 million. So I've got more invested in that market, but I'd actually rather have less invested, but in a higher quality asset. So it's something that I talk about a lot in this podcast, but something to sort of keep in the back of your mind. If you feel like you're starting to lean towards, hey, let's go and buy a whole bunch of properties, maybe you can have a listen to some of those episodes I've spoken about quality. And in fact, I published a case study episode on the 16th of July, 2024, called Quality is King, that talked about a particular client that made this very point. So go back and have a look at that if you like. So to sum up, property plans, I think, are a great business for the people providing them. It's very commercially attractive. The advice tends to be largely templated, so it's pretty straightforward and easy to prepare. The business risk is low because a lot of the advice is unregulated. Anything relating to, property, cash flow management, just broader sort of borrowing arrangements and capacity don't attract any sort of licenses or oversight. Of course, that means, consumers don't have a lot of protection either. And of course, if I deliver a plan that, tells someone you should go and buy 3 properties and I'm a buyer's agent, well, of course, then I'm going to pick up the fees on the back end in terms of buying those properties. So it's very, very lucrative. But given the limited nature of the scope that's included with property plans, I just question whether they're really worth paying for. Is it really worth paying? You pay some money for it, but, to how much is a decision that you need to contemplate if you're considering that service. But next week, I'm going to talk about, my episode next week is about talking about, what actions can you take if you're not ready for full-blown financial advice? Because I guess if you're not going to do a property plan, people might be thinking, okay, well then I need to engage a financial advisor and get a holistic plan. But that might not be right for you either in terms of the right stage of advice. So if you're in the middle somewhere, what do you do? That's in fact my topic next week. And it's a common question that I get in the podcast. which is, if it's not worth me paying, $5,000 a year for financial advice, what do I do? Anyway, I'm going to talk about that next week. Okay, let's get into some listener questions now. And the first one is from someone that would like to remain anonymous. And they write, I've really enjoyed listening to your podcast. They provide really good information on building wealth that I wouldn't have known if I hadn't come across them. So thanks very much and keep up the great work. Thank you very much. My wife and I are building our forever home in Adelaide. We're both in our mid-30s. We sold my wife's townhouse to fund part of the build. I'm predicting by the end of the build, the house will be worth 1.6 with about $550,000 of a mortgage. My wife earns $120,000 a year and $100,000 a year, and we have combined $230,000 in super and about $80,000 in shares. I've worked out that we'll have a surplus cash for around $4,000 a month after mortgage repayments and living expenses. And we have a small buffer around $20,000 in our offset account and plan to start a family in the next couple of years. We're looking for ways to build our wealth and unsure which option might be more suitable. Investing in shares, purchasing an investment property, or focusing on repaying the home loan and making additional super contributions. Our wages will increase modestly in the future. My wife is worried that if we invest in property, it'll put too much pressure on our cash flow, especially since we'll be starting a family soon. Any general advice would be great. And of course, all the information in the podcast is information, not advice. But let me think about what would I do. So about $50,000 of surplus income per year. It's a little over $500,000 of home loan debt, $230,000 of super in their mid-30s, which isn't too bad. It's kind of sort of on track. The problem is not too much in cash savings, which is cash flow buffer to get you through sort of starting a young family. And even relatively even incomes is a problem as well, because when one spouse stops working, has a pretty big impact. I mean, the surplus cash flow will evaporate, of course, during that time. Just generally, in situations like this where I want to start a family in a couple of years' time, have a pretty strong surplus cash flow, what do I do? I've taken sort of two approaches, if you like. In terms of, actually, let me step back. The next best step is go and buy an investment property. Like, put aside the family planning and starting, having kids. In fact, if this listener said, I'm not going to have kids, it's a no-brainer. Go and invest in property, because their mid-30s, their super will do its thing anyway, just through the employer contributions and, having, 20 plus years up their sleeve to enjoy compounding capital growth. It makes sense, right? Go and buy an investment property. But in this situation where you want to start a family, what do you do around that? Well, there's really two approaches with respect to that. So obviously, don't go and invest in property, or structure yourself so that property isn't going to harm your cash flow. And you could do that by building in significant buffers into the loan, because, of course, during the period of time where one person isn't working, there's not going to be any surplus cash flow. And you might have an investment property that might be costing you, let's say let's be conservative, $25,000 a year after tax. And so if you've got no surplus cash flow, how are you going to pay for the investment property? Well, if you build in a buffer to a loan, you might actually use some debt to pay for that negative cash flow. And if you are confident that you can do that for a very finite period of time, let's say 2 years, that's $50,000. So I'd rather then get into the property market today, even though I know I'm going to borrow an extra $50,000 to fund the negative cash flow over a couple of years, as opposed to not get into the property market today and have to wait another 5 years. In 5 years' time, the property that I'm probably going to buy is going to cost me a lot more money, and I've missed out on that growth. So that's one way to look at it. It's not for everyone. It is a little bit on the aggressive side, so I acknowledge that. And it's not for everyone. If you can't get your head around the investing in property, and really, if you're going to do it, you need to do it properly, right? So you might go, well, I'll invest in property, but try and minimize the negative cash flow and minimizing the amount I'm going to invest. But I'd argue then all you're going to do is sort of take higher risk, because you're getting a potentially in below average grade property. So if this person's going to do it, you may as well do it properly. And doing it properly is going to give rise to, a shortfall in cash flow, of course. But hopefully what they can do is buy the investment property, the cash flow shortfall hopefully won't eat up all their surplus, which is about 50,000, and then they can build more of a buffer into their home loan. So that's one option if you're comfortable doing that. Now, again, I'll just maybe I haven't made it really clear. If you go and buy, say, $700,000 investment property and you've got a lot of equity in your home, you might actually borrow 700,000, let's say 40,000 for costs, and then build in another $100,000 worth of buffer. So then go and borrow $840,000 to buy the $700,000 property. And you've always got ready access to additional money should you need it through redraw because you're not going to use the full loan. And that's what I'm talking about, that buffer you could potentially lean on to get you through that period of time where, one spouse isn't working at all and it's having an impact on your surplus cash flow. The alternative is to not do it. And if you didn't do it, then I would probably invest in some shares and put some into the home loan. I'm not too concerned about the home loan because you're mid-30s, got pretty good incomes, and it's only $550,000, which in today's measure isn't a big home loan. So I don't really want to I don't think extra home loan repayments is a massive priority. It's really just about building that buffer and then investing in shares as well. But great question. And, there's obviously a bunch of people, it's a very similar sort of situation where they sort of contemplate. And hopefully you can get your head around potentially investing in property because I think in the long run, that's probably a good way to go. All right, short of time, I might just leave it there for today. And as I said, next week, we're going to talk about, what do you do if, you're not ready for financial advice? How do you navigate some of those key financial decisions? It's a question that I often get asked. So I look forward to sharing that one with you. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.